What's up, everybody? Mike Ferrasi coming to you with another episode of Mortgage 101, where we go over some of those fantastic mortgage basics for those new to our industry and for borrowers who are looking to learn a little bit more. Today, I got a question, and it hit home because as an industry veteran, things weren't always this way. It was about pricing out a loan with a higher loan amount versus a lower loan amount. A conventional loan, specifically. See, up until recently, higher loan amounts, they got priced better. And as the loan amount dropped, especially when you crossed under that $200,000 level, the pricing got worse and worse and worse via loan level price adjustments. It's not that way anymore. Your pricing actually gets better and better and better. And today we're going to review why. Now, this is a bit of a complicated thing, so I'm going to keep it as simple as I possibly can. I'm going to leave out spec pool pay-ups, pricing mandatory to Fannie versus other investors, different loan amount buckets, things like that, because, well, then this really wouldn't be a 101 video, now would it? So today, we're just going to stick to talking about servicing values and what it means to pricing those loans. As most industry veterans know, but not a whole lot of beginners, mortgage loans are a commodity that is often bought and sold on the secondary market. Now that commodity, that loan that's being sold to an investor, consists of a lot of different factors, risk factors, to see how much that loan is worth. You have FICO score, debt to income ratio, loan to value ratios, employment histories, all sorts of different stuff. But included in all those factors are obviously the loan amount and the interest rate that loan was written at. Now, based on the loan amount and the interest rate, you're going to get the payment. But more importantly, to the investors who are purchasing these commodities, that's going to help you figure out how much money they're going to make. All the interest payments coming in every month are what makes that loan valuable as an investment. The higher the interest rate, the more interest that's coming in. The higher the loan amount, the more interest that's coming in. And that sounds like a good thing, right? Well, not always. Because if that loan ceases to exist because, I don't know, the borrower refinances to take out cash or into a better rate, that loan, that investment, it also ceases to exist. And those interest payments don't go to that end investor anymore. They're now going to the investor who purchased the new loan, the refinanced loan that borrower just did. So there's a fine line you have to walk. For loan officers, you see this in your rate sheets, your rate stacks, your online pricing engines. You see this every single day. Have you ever wondered why when you get to a certain interest rate, the price just stops getting better? Right now, you're probably looking at something in the low 3% range, thinking it's pricing really, really well. But what if I kick that borrower's rate up to 4%? Would it price even better so I could cover more of their costs? No. Sometimes that 4% might price even worse than the 3% interest rate. And the reason why is because the investors and the servicers know that if you give that borrower a 4% rate in today's market, they're probably just going to refinance into a lower interest rate a couple of months from now. So they're not going to pay a better price to acquire a loan that's not going to exist very long because they're not going to be collecting interest on it for more than a few months. That's a net loss to them. It's a bad investment. The same logic has started being applied to loan amounts, conventional loan amounts specifically. Once we get under a $250,000 loan amount on a conventional loan, your pricing starts getting better, and it could be a lot better. There are some lenders and investors out there where if you compare the price at a specific rate on a $250,000 loan versus a $80,000 loan, that $80,000 loan could be priced a full 3 points better. I mean, these are huge jumps. Now, don't get me wrong. It's not as huge as you'd normally think because those points are percentages of a loan amount. And when the loan amount keeps going down, the percentages, they don't add up to the same dollars and cents that they would if the loan amount was higher. So there's a give take there. But those low loan amounts are still paying up a ton. And it's because the lower the loan amount, the lower your mortgage payment, right? The lower the mortgage payment, the percentage points don't turn into dollars and cents quite like they do on the higher loan amounts. So with the low loan amount loans, those tend to be refinanced far less often. Here's a quick example. If you have a standard run-of-the-mill conventional $300,000 loan and you lower the interest rate from 3% to 2.5%, you're looking at about an $80 a month savings in principal and interest. Now, if you take an $85,000 loan instead of a $300,000 loan and you have the same 3% interest rate and you lower it to the same 2.5%, the monthly payment, the principal and interest savings, it's just over $20 a month. Is that $20 a month savings going to be enough to convince someone to refinance, provide all the documentation, sign all the paperwork, do the whole thing, especially if they're going to have to pay any loan fees on top of it to save $20 a month? Most people are just going to stick with their current loan. And that's exactly why pricing right now is so much better the lower the loan amount goes. Because the lower the loan amount goes, the longer that loan is going to exist in a servicing portfolio, and the longer that the end investor is going to be collecting interest from that borrower. I understand it seems backwards to a lot of industry veterans, but for those new to the business, this is all they know, and it's probably making sense a little bit easier to them. So the next time you come across this, whether it's a low loan amount, paying up a lot more, or you're seeing higher interest rates not pay up like you think they should, know that it's because of the servicing value of that loan. Because that loan being priced in that sweet spot is going to exist for as long as possible. And that's what's important to an investor. And that's what makes a loan worth more. Don't look at it as a negative. It's actually a positive thing. When it comes to that loan amount stuff, $250,000 is about where your base price on those conventional loans are going to be. They're not setting base prices at a $20,000 loan amount and then adding loan level price and rate adjustments for the worse as the loan amounts get higher. No, they're actually doing the opposite. Your base price is set around that $250,000 mark, and then as the loan amounts get lower, you're getting pay ups as opposed to getting hits for higher loan amounts. This isn't a negative thing, so don't spin it that way. I know, especially if it affects your transaction, it's easy to think that, but higher loan amounts are not being punished. Higher loan amounts are being priced just like they have been for a while now. But lower loan amounts, those are the ones getting the benefits of the pay-ups on these transactions. I hope that makes sense, and I hope it gives you a little insight into what makes a loan valuable on the secondary market to an investor. Thanks a lot for joining me on Mortgage 101, and we'll talk to you guys next time.